On December 11, 2025, Asian investors faced a market split between hope and fear. Oracle signaled caution, hinting the AI boom might be overhyped. Meanwhile, the U.S. Federal Reserve suggested borrowing would get easier, a boost for stocks. But Oracle's disappointing report cast a heavy shadow. The fear that the AI rally was shaky outweighed the Fed's optimism. The market's tug-of-war between hope and fear was on full display.
Oracle, long a steady tech player, became a key AI infrastructure provider as the AI boom took off. Investors saw Oracle as a barometer for AI spending. But its latest earnings were just okay, and its future spending plans were underwhelming. The market had priced Oracle and other tech stocks for perfection, assuming endless demand for AI infrastructure. Oracle's report suggested limits. Budgets might be tighter than expected. Oracle's stock plunged over 10% after hours, and the shockwaves hit the entire AI ecosystem. If Oracle wasn't seeing boundless demand, what did that mean for others like Nvidia? Nvidia's stock also dropped as investors feared a slowdown in AI data center spending. The Oracle effect showed how sentiment drives markets, sometimes more than the numbers themselves. The story of unrestrained AI growth was suddenly in doubt. Investors quickly re-evaluated the high prices they'd paid for AI stocks. When perfection is priced in, any crack in the story can cause a sharp correction. The foundation of the AI rally looked less solid. Oracle's report was a wake-up call for the entire sector. The AI narrative had shifted from euphoria to caution overnight.
News of Oracle's disappointing report raced across the globe, hitting Asian trading desks by morning. Tech-heavy Asian markets felt the chill immediately. The logic was simple. If U.S. firms spend less on AI, Asian suppliers, from chip makers to software firms, would suffer too. The sell-off was targeted, hitting companies most exposed to the AI boom. The global tech supply chain is deeply interconnected. A single U.S. company's forecast can move stocks in Taiwan or Tokyo. Taiwan Semiconductor Manufacturing Company, TSMC, a key supplier to Nvidia and Apple, saw its stock drop 2.3%. This was worsened by TSMC's own weak sales data, compounding investor anxiety. The Oracle news and TSMC's sales created a perfect storm for the Taiwanese market. The lesson: geographic diversification doesn't shield you from sector-specific shocks. If you're heavy in global tech, it doesn't matter where your stocks are listed. AI doubts hit everywhere. The AI rally was global, and so was the stumble. Oracle's report reminded everyone. In tech, no market is an island. The ripple effect was swift and severe. Investors saw how quickly sentiment could turn. The day's fear was contagious, spreading far beyond Silicon Valley. Japan's markets were hit hard, reflecting the country's deep ties to the global tech supply chain and AI excitement. SoftBank, a major AI investor, became the day's symbol. Its shares plunged over 8% after Oracle's news. Investors feared SoftBank's tech-heavy portfolio would lose value, amplifying market anxiety. The pain spread to Japanese semiconductor suppliers, who rely on demand from chip makers like TSMC and Samsung. Any slowdown in AI spending would ripple down the supply chain, hurting these firms. Investors sold first, asked questions later, a common reaction when a hot theme is challenged. Amid the gloom, one bright spot emerged. Advantest, a chip testing firm, rose on news that Nvidia could sell more chips to China. This exception showed how specific news can create winners, even in a broad sell-off. Still, Oracle's negative impact dominated, and Japan's market ended deep in the red. The day highlighted how quickly sentiment can shift in tech-driven markets. The AI party's vulnerability was exposed. Investors were reminded that hype can turn to fear in an instant. The Japanese market's reaction was a warning for all tech investors. Even the strongest narratives can unravel quickly. In China and Hong Kong, the market's worries were different. Less about AI hype fading, more about rising competition. Chinese indexes fell, and Hong Kong's Hang Seng was flat, but local chip stocks slumped. The trigger? The US allowed Nvidia to sell more advanced AI chips to China. For Chinese chipmakers like SMIC and Huahong, this was a direct threat. Competing with Nvidia's superior chips could squeeze their profits and slow growth. Shares of SMIC and Huahong dropped about 2.5%, marking a third straight day of losses. Here, the fear wasn't about shrinking AI demand, but about a powerful rival entering the market. The narrative diverged from Japan and Taiwan. China's tech sector was battling for survival against global giants. The Hang Seng stayed flat thanks to strength in other sectors, but tech stocks bore the brunt. The day highlighted China's unique challenges, geopolitics, and fierce competition. For Chinese tech, the fight is as much about market share as about innovation. The market's reaction reflected these local realities. The battle for chip supremacy was front and center. On this day, fear of losing ground to Nvidia weighed heavily on investors.
The U.S. Federal Reserve surprised markets with a rate cut and new bond buying program, moves that usually boost stocks. Chair Powell's announcement signaled strong support for the economy, promising more liquidity and lower borrowing costs. But tech sector fears, led by Oracle, overshadowed the Fed's good news. The day became a tug-of-war between hope and fear, leaving investors uncertain which story mattered more.
Outside the tech hubs, Asian markets reacted in diverse ways, shaped by their own economic structures. Australia's ASX 200 rose, buoyed by banks and miners, sectors that benefit from lower global rates. Softer local labor data also raised hopes for an Australian rate cut, making Oracle's woes less relevant. India's Nifty 50 climbed, as its market is less exposed to hardware and more to IT services, which aren't as tied to AI chip spending. Investors in Mumbai focused on the Fed's dovish stance, expecting more foreign investment. Singapore's Straits Times Index, led by banks and real estate, also ticked up. South Korea's Kospi ended flat, reflecting its split between tech giants and industrial firms. Losses in tech were offset by gains in industrials, thanks to the prospect of lower rates. The mixed performance showed how local factors can outweigh global themes. Not every market is driven by tech, and those with different sector weightings fared better. The day was a lesson in the importance of market composition. Some markets rose, others fell. Each told its own story. The region's diversity was on full display. The Fed's support mattered most, where tech wasn't king.
For investors, days like this are a test of conviction. One headline says the Fed is boosting the economy, a reason to buy. Another warns the AI boom is faltering, a reason to sell. The dilemma is classic. Focus on the big economic picture or the health of your specific stocks. Short-term traders may bail on tech, fearing immediate losses. They react to the Oracle shock, sidelining the Fed's longer-term support. Long-term investors might see opportunity, betting that AI's promise will outlast today's fears. They view the Fed's actions as a foundation for future growth. The same facts can lead to opposite decisions. The story of the day was fear in tech, but hope in the economy. Investors had to choose which narrative would shape their strategy. The market's mixed reaction showed no clear consensus. Some ran from the fire alarm, others danced to the music. Navigating these contradictions is the heart of investing. Today's market turmoil offers key lessons for the future. Even the strongest investment stories, like the AI boom, have limits. When perfection is priced in, any disappointment can trigger sharp corrections. The varied reactions across Asia show that local factors matter more than ever. China's fears of competition, Japan's worries about spending, and Australia's optimism all played out differently. A one-size-fits-all approach to Asian investing is fading. Central banks still hold immense power. The Fed's support put a floor under the market, even as tech wobbled. Sector-specific shocks can cause pain, but broad collapse is less likely with central bank backing. The future will require balance between tech optimism and business reality, global trends and local dynamics, fear and confidence. Today's tremors weren't an earthquake, but a warning to check your portfolio's foundations. The market's tug-of-war is far from over. Investors must stay alert, adaptable, and ready for more surprises. The only certainty is uncertainty itself.